I'm Jennifer Campbell, one of the co-chairs of the Executive Committee of the Beverly Hills Bar Association's Trust and Estates section. Welcome to our program today entitled Income Tax Planning with Trusts. No such thing as a new idea. It's going to be a great program, and I'm glad you're here with us. Before we begin, I have a couple housekeeping announcements. The link for today's material is in the chat box now, and there will be a follow-up email with the materials later as well. You will receive your MCLE certificate shortly after the program. Please take a moment to complete the survey that is included with your certificate. And now a word or two about our section's wonderful sponsors. The Trust and Estate section is sponsored by the Sanborn team, Geffen Real Estate, Glen Escrow, California Title Company, and Manufacturers Bank. First, let me introduce Nancy Sanborn and Brian Joy of the Sanborn team to say a few words.
Thank you so much. And thanks to the support of the bar, we've had the good fortune of selling 62 properties in 2021, of which 28 required court approval and 9 were overbid in court. Like you, we've made many adjustments in the last year and a half, and we continue to strive to be the very best we can.
And if we get an opportunity, we hope to get to show each and every one of you what we can do. Have a great day, and thanks for your hard work.
Thank you, Nancy and Brian. And now let me introduce Orit Gadish of Geffen Real Estate and a recently published author to say a few words.
Thanks so much, Jennifer. Hi, everyone. I'm Orit Gadish, broker and owner of Geffen Real Estate, a dynamic brokerage specializing in serving the trust and estate community with a team of 25 agents with boots on the ground throughout Southern California. I recently launched my book titled The Practitioner's Handbook for Probate Real Estate. Thank you so much for those of you who have read it and wrote a review. I truly appreciate it. For those of you who have not read it, please take a minute to check it out. It's available on Amazon, and the link is in the chat box. Take a few minutes to read the reviews, and if you're interested in reading it and providing a review, please text me and I'll have a complimentary copy shipped to you. Enjoy your program, and back to you, Jennifer.
Thank you, Orit. In addition to the Sanborn team and Geffen Real Estate, the Trust and Estate section is also sponsored by Glen Escrow. Marcine Klein is a full-service escrow officer specializing in probate, trust sales, conservatorship, and both court and independent administration of estates act transactions. On a daily basis, Marcine works to ensure that even the most challenging escrows close smoothly and that her clients are beyond happy with their experience at Glen Escrow. California Title Company provides comprehensive and timely title insurance protection for home buyers, including first-time home buyers, sellers, veterans, and military personnel, as well as seniors, real estate agents, brokers, mortgage lenders, and commercial real estate professionals. Manufacturers Bank. Simplify your banking. Let Manufacturers Bank do it for you. Manufacturers Bank has a dedicated trust and estates banking team with the experience to handle all your banking needs. Please contact Brian Flores, Vice President and Senior Relationship Manager, for more information. And now I have the pleasure today of introducing Beth Acevedo, who will provide us with our legal updates today. Beth, the floor is yours.
Hi, everyone. We have 2 cases we're going to cover today, one new and one that we actually discussed in February. So the first is Agayan v. Manassian, a 2nd District Court of Appeal, case number B296287, which was filed on May 24th, 2021. In that case, Seda Galstian Agayan and Ida Galstian Nahadian, as plaintiffs in their individual capacities and as trustees of their deceased parents' trusts, sued Shahan Manassian, alleging that he improperly obtained money and property from their deceased parents. The plaintiff's parents entered into a contract with Manassian, pursuant to which they executed a power of attorney to authorize him to reclaim and sell property on their behalf. The plaintiff's parents died in 2012, and in January 2013, they filed a complaint against Manassian for unjust enrichment. More than 2 years later, they filed successor and interest affidavits under California Code of Civil Procedure 377.32 and filed a second amended complaint. On a motion to dismiss or stay for forum nonconvenience, Manassian argued that the plaintiffs failed to timely or properly file their successor and interest affidavits because the affidavits must be filed prior to initiating an action on decedent's claims. They also alleged that the causes of actions belong to the decedent's estates, that the affidavits were filed after the statute of limitations ran, and that the plaintiffs only alleged harm against themselves in their individual capacities rather than their parents. The trial court denied the motion. On appeal, the Court of Appeal affirmed, stating that because a successor in interest affidavit is not a condition precedent to filing a suit as a decedent's successor in interest, the plaintiff's failure to immediately file the affidavits did not nullify their complaints. Further, the court stated that on appeal that the Manassian's argument that the claims could only be pursued by the personal representative was forfeited as it was unsupported by any meaningful analysis or citation. In addition, none of the authorities cited by Manassian supported his claims that the plaintiff's case was time barred because the statute of limitations continued to run until filing the successor in interest affidavit. And finally, the court determined that the plaintiffs had properly alleged that Manassian harmed the decedents, not the plaintiffs individually. The second case is Breslin v. Breslin, which is a Second District Court of Appeals case number B301382, filed in January 26, 2021. We discussed this case in February, shortly after a decision was issued by the Court of Appeal. As a reminder, in this case, Don Kirshner died in 2018, leaving no wife or children, but a trust. The portion of the trust listing the residual beneficiaries was lost. However, a document titled Estate Charities was found and listed 24 charities with handwritten notations that appeared to be percentages. David Breslin filed a petition in probate court to determine that he was trustee and to determine the beneficiaries of the trusts. He served the 24 charities, but only 3 responded. Probate court ordered all parties to mediation, and one of the charities gave formal notice informing the parties that if they did not participate, they may forfeit their rights as they relate to the trust. Only 5 charities participated in mediation, and at mediation, the attendees reached a settlement agreement providing for those 5 charities, the intestate heirs, and attorney's fees. Breslin filed a petition to confirm the settlement, and a charity that had not previously appeared in the action or participated in mediation objected. The probate court granted the petition to confirm the settlement and denied the objections without an evidentiary hearing because the charity had not appeared in the action or participated in mediation. The Court of Appeal found that the trial court had authority to order parties to mediation under Probate Code Section 17206, and that because the charity failed to respond to the mediation order, the charity had waived its right to an evidentiary hearing on its objections to the settlement agreement. The charity subsequently filed a petition for review and a request for depublication with the California Supreme Court. On July 14, 2021, the Supreme Court denied the petition and the depublication request, thereby making the Court of Appeals decision authority to which attorneys may cite for the proposition that, at least under circumstances similar to those in Breslin, due process is satisfied when all potential beneficiaries receive notice of mediation that advises them of the date, time, and place of mediation, the opportunity to participate in the mediation, and includes a warning that a failure to participate in the mediation may result in the loss of any potential interest in the trust or estate, such that a voluntary agreement reached at mediation will be enforced against those persons receiving the notice without objection. I'm now going to turn it over to Dina, who can introduce our speaker.
Hi, thanks, Beth. Hi, I'm Dina Nam, one of the assistant program co-chairs, and I'm here to introduce our speaker. Before I do that, I just wanted to say one quick housekeeping matter for the group. For any questions that you would like to have our speaker address, to the extent we have time at the end, please put them in the Q&A chat at the bottom. You'll be able to put in your questions, and we'll field them at the end of the presentation. But for now, I'm very pleased to introduce our speaker today, Daniel Lorenzen. He is a partner at Fox Rothschild. He works with a wide range of clients and business owners and advises them on not only all aspects of wealth and tax planning, but federal, state, and international income tax issues. He works closely with both domestic and international clients on cross-border estate and trust administration matters. And one interesting fact about Daniel is that he speaks fluent Japanese and has worked with Japan-based businesses and advised them on their US-based operations here. So without further ado, I'm pleased to welcome our speaker, and we look forward to having him. Daniel?
Good afternoon, everyone. It's really nice to be here. So I have only one item of throat clearing here, which is just to note that this is kind of a broad survey topic. And so we're going to drill down on some items that are very interesting. And while we do so, we're going to skip many other items that are also very interesting. So I apologize in advance if we don't get to what interests you the most here. Secondly, the title, that no such thing as a new idea, is an aphorism attributed to Mark Twain. And I'm going to end up showing you, I think, just how true that is very quickly. And it'd be nice in these presentations to look forward, especially this year, and say what's going to be happening with the tax environment in the coming months and year. And I'm very bad at that. And instead, I'm going to do the opposite, which might seem frustrating, but I will keep it brief, which is we're going to look back into history just a little bit to give us some context as to where we are in this current environment. So forgive me for a few minutes. We'll just take a backwards look a little bit at where we are. And to start with that, we're actually going to go back to the 16th century. Now, no one from a legal history viewpoint, no one will dispute you if you propose that trusts have existed as a matter of English practice for 11 or 1200 years even. That's not controversial. The exact path trusts took for that 11 or 1200 years, though, is subject to a lot of hot controversy in the small community of legal historical scholars there are, at least from what it appears to me. So we can freeze frame, though, in the 16th century, what we think of as trusts today were called uses. And don't even ask what the word use was supposed to mean. The etymology of that is hotly disputed. But certain trusts in land were called uses, and King Henry VIII was losing revenue from these uses because the royal household could only charge tax to the legal owner of land, and uses weren't done on title. They were done as extra title arrangements to convey land in trust to a trustee for the benefit of a beneficiary. And the landowner, the original landowner or the settlor of the trust was long gone, and there was no one to charge the land taxes to. And so Henry VIII had experienced significant revenue loss from this system. And he had sort of squandered all of his goodwill with Parliament through his matrimonial issues and his separation from the Roman Church. And so Parliament was in no mood to find him new sources of revenue on top of all of that he had put them through. And so he had to go find existing sources of revenue that were lost. And one of these was these uses in land that was taking away his land revenue. Very interestingly, many members of Parliament were lawyers at the time. And I'm pointing out parts of this story, if you can't tell, that might be somewhat similar to our times today. But many members of Parliament were lawyers, and lawyers had helped set up these complicated schemes and had benefited from fees for setting up these use schemes. And Henry decided he would actually have to negotiate with the lawyers to craft a bill that would extract a fair amount of lost income back to the royal household while still allowing some flavor of these things to legally exist. His minister at the time, who had various offices, was Edward Coke. I'm told it's pronounced Cook. His famous quote about this during the time is that there were two inventors of uses, fear and fraud. Fear in times of troubles and civil wars to save their inheritances from being forfeited, and fraud to defeat due debts, lawful actions. And if we take away fraudulent conveyance out of this, asset protection certainly remains a relevant use of trust today. In addition to, I'd say, in a very well-enforced tax jurisdictions we live in, at least tax efficiency or tax minimization. And these conditions were very similar 400 years ago. Henry ultimately adopted the Statute of Uses and passed it through Parliament, which partly banned uses. But the version of them that survived got renamed as trusts, and that's the first time we have the word trust being used shortly after this time, being used to describe the things we are all familiar with. We're going to fast forward now all the way to 1930s America. And the Dean Trust is a US federal court case. There was no tax court back then that approved a trust structure that's essentially a classic income tax shelter for trusts. In other words, an individual would have income being realized at higher and higher brackets and would take some of those income producing assets that were earning income at the higher brackets and contribute them to a trust. And the trust would then start filling up that same income at lower tax brackets. Okay, in the Dean Trust, what would happen is the very next tax year on January 15th of every year, the income that had been paid by the trust and is now principal, essentially, in the prior year would then be distributed back. I guess it seemed unseemly to give it back to the settlor of the trust, so it went to the settlor's spouse. And the income would just flow back, having been laundered through lower income tax rates with the trust. And this was approved by federal courts as a valid strategy as recently, I guess, as 1939. This kind of arrangement seemed to cause a lot of consternation among the bar. The Yale Law Review, I found at least half a dozen articles in the 1940s wringing their hands over the Dean Trust and the whole system of the trust taxation. Here's an example stating that the taxation of trust income has been an ever-vexing problem. Well, the problem got solved into the rather complex system we have today. And we could think of the various responses to the income tax shelter planning and trusts as coalescing around the post-war period, although none of these things are directly in the post-war period necessarily. It's a good fulcrum point for moving us past that 1930s period into how the government fashioned responses to that kind of income tax planning. And three major things that still define the trust tax structure that we live in today are: one, the compressed income tax rate structure for trusts. So trusts don't enjoy a very wide band of low rate income. The federal gift tax itself, which is a disincentive to fund trusts in the first place, with the specter of a large tax on the initial transfer to the trust. And the grantor rules, which say that if the grantor retains enough control over this trust, or the settlor, it's the same term, we're just going to attribute that income back to the grantor anyway. And so that would be at the grantor's top rates, presumably. So these are three devastating policies. They're devastating to the Dean Trust type planning and devastating to using trusts as income tax shelters in general. And they've developed largely into that role, at least in the post-war period. To look at each just briefly. The current compressed rate structure for trusts says that after $12,900, about $13,000 in income, trusts are paying tax. These are non-grantor trusts. Okay, so these are trusts as separate taxpayers, are paying federal taxes at the top marginal rate already. So if you're going to shift lower rate income into a trust, you might be paying more federal taxes than you would have if you hadn't at all. Now, this is for ordinary income. Capital gains has a sort of a smaller set of rate brackets at the 15 and 20% level. And the top rate, 20% rate for capital gains is reached after a slightly different $12,000 number. Of course, it has to be different, right? Compare that to individuals pay the 20% capital gains rate after $441,000. So there's some difference there too. But you're going to see that capital gains, because a lot of that income is taxed at 20% anyway, and we're talking about over $1 million, let's say, are an attractive concept for some non-grantor trust planning still, even with the compressed rate structure. Now, the federal gift tax had some fits and starts as it developed, but the modern version of it started with the 1932 overhaul. And back then it had a 30% rate, $50,000 exemption amount, and a $5,000 annual exclusion. And at the time, it was not unified with the estate tax on purpose. And it was actually, the rate was set purposely at 10 to 15% less than the estate tax rate. And the point of the gift tax then was to get people to make gifts. And by charging a cheaper rate for gifts, the government would realize some taxes sooner. And this is as the Great Depression is in its deepest pit. The government would get people to make gifts at lower rates than they could transfer on deathbed or after death through the estate tax system. So it was meant to be incentivized to make gifts and pay gift tax early on. We since unified these, so we don't have that incentive feature of the gift tax anymore. Yes, I did go back and check that $50,000 exemption number to see what it is in 2021 dollars, and it's just under $1 million. So it was still a fairly generous exemption from the inception of the gift tax, and that whole amount could be transferred to trust without being a disincentive at all. Just like the unified exemption amount today, when we're below that number, we're not disincentivized from funding trusts at all. The grantor trust rules have an interesting history, but briefly, there was a 1945 case that said that if a grantor retained too many powers over a trust, then the government should just tax the grantor on the trust income. And the IRS was very happy with that result, and Treasury added the result of that case into regulations at first. By the 1960s, these grantor trust rules have been worked into statutory law and became part of subchapter J. And these are the rules that defeat dean trust planning by saying we're going to tax the grantor anyway if there are too many powers retained by the grantor with respect to the trust. So you can try putting income into a trust, but it's going to come back again at the grantor's marginal rates at that point where it started. So just to revisit these post-war responses, this is a rather devastating system for any kind of income tax sheltering for trust. If one of these rules doesn't get you, the other 2 or 3 might get you, and they can smother you like a blanket in doing that kind of planning. I've added one to this list. It doesn't exist anymore, at least for domestic trusts. And that's the throwback tax too, which was added in the 1950s. And the throwback tax said, if you accumulate income in a trust successfully and you get through all these other rules and manage to accumulate income at lower rates in a trust somehow, as soon as you get distributions from that, even if it's in a later tax year, and if you remember, the dean trust would wait 1 year and then the income would come back to the spousal group at least. And the throwback rule said, we're going to track the income tax we lost from that. We're going to tax you back when the income comes back to you. By the 1980s, it seems these other 3 rules had enough of a smothering effect on that kind of planning to where the throwback tax for domestic trusts wasn't that necessary or invoked very often. And so it got taken away from domestic trusts, but continues to apply to foreign trusts. So, and this largely describes the system we live under today. And if you ask why is it as complicated as it is because of what taxpayers did in the past and what the various responses have been over the years. But what it leaves us with is a remarkably flexible system for who pays the tax with respect to a trust, with the 3 major roles of classes of persons involved in a trust: settlors, trustees, beneficiaries. Any of them can pay the tax. And what's interesting about our system is it's designed so that through conscious planning or through conscientious administration of a trust, you can decide which of these 3 you want to pay the taxes. That's somewhat unique internationally with how trusts are taxed in other jurisdictions. It's more flexible here than it probably is anywhere else. And through the 2 major varieties of trust, then being grantor trusts or non-grantor trusts, and then 3 possible taxpayers coming out of the wash there. So it's a complicated system, but it has a lot of flexibility in it still. It took, as these post-war responses came out, it didn't take the practice community very long to figure out that there was a silver lining to the grantor trust rules. Okay. And I believe it's been about the past 20 years, grantor trusts have been an extremely popular estate planning vehicle. And a lot of ink has been spilled about them and a lot of presentations like this have been given. But the key advantages to the grantor system are intentionally triggering those grantor trust rules that were supposed to be disencouraging for funding trusts, is that the settlor can enter into sales or exchanges with a trust with no income tax realization by either party. And that's a very flexible planning tool. Similarly, the settlor can pay taxes. So as the tax liability falls with the settlor, that lets the trust assets grow free of any tax obligations. So the settlor essentially contributes gift tax-free tax payments to the trust because of the legal setup. And we're left to then answer, after having done this for so many years now, what exactly is defective about this kind of plan? And I think I've been practicing for long enough to see that defective word, which was initially used for grantor trust planning, start to drop out of usage. So where are we today after kind of looking at how we got to this moment and how long the history is of tax minimization strategies involving trusts, which goes back hundreds of years? Why are we talking about this again today? And one reason is that the marginal income tax rates, so capital gains rates for Californians, if you add federal and state tax and maybe add the Obamacare surtax, it's somewhere in the 37% range. That's for capital gain property. And the estate tax marginal rate is 40%. So these are close, historically close together. In the past, if estate tax rates were 60 or 65% after the 86 tax cuts, that was far higher than the income tax rates, and we would always prioritize saving on future estate taxes versus current income taxes. Today, this is much more of a trade-off than it may have been in the past. California is a high tax state. There's no capital gains preference in California's income tax rates. And since 2017, we've had the SALT deduction limitations. I threw an asterisk in here because I've learned that this morning, the governor signed the SALT workaround bill in California, which had been worked out with the IRS too, which I'm not prepared to speak about, but it's something that might be mitigated a bit by using entities, pass-through entities, to pass through a credit on taxes paid that the owners of those entities can use to work around some of the limitations on SALT deductions. That may be becoming a factor that can be mitigated a little bit more. High estate tax exemptions means that estate taxes are relatively less of a worry to many folks than they were 5, 6 years ago, especially 10, 20 years ago, for instance. So the estate tax applies to fewer and fewer people. And younger clients with wealth, especially in the West or Southwest US, younger clients, the calculation there is that current income tax savings can be compounded into the future to be extremely valuable, whereas estate tax liabilities that are decades in the future, when they're discounted down to present value, aren't very onerous. And so younger clients tend to be more interested in getting current income tax savings and having that compound than they are in saving on estate taxes, which may not happen for decades which may not apply for decades in the future. So these trends have us continuing to discuss how to do income tax planning with trusts. Okay. We're going to leave grantor trusts mostly behind for the rest of the presentation because they've been, although still very valid and very good planning opportunity, they've been covered very well. And the trends I just mentioned converging are ones that want to have us consider what are the benefits of non-grantor trusts, primarily in their definition as being a separate taxpayer. Okay. Why does being a separate taxpayer help? And I want to think of 3 different buckets or 3 different labels under which a non-grantor trust can be useful as a separate taxpayer. And one bucket is statutory. So some tax laws give benefits, provide tax benefits on a per taxpayer basis. So you would just logically think if a settlor of a trust is one taxpayer, but they can make a non-grantor trust be another taxpayer, can we multiply that statutory benefit in 2? Because the statute says per taxpayer basis. So that's one area in which a non-grantor trust might be quite useful. Another is jurisdictional, and that asks the question, can a separate taxpayer reside in a jurisdiction other than yours? So can we have a settlor in one tax jurisdiction and a non-grantor trust in another tax jurisdiction? The answer is yes, we can. And what does that mean? And lastly is, I think of as an enabling function, which is that non-grantor trust can allow some other kinds of planning to happen. And sometimes just having a separate taxpayer might create a true partner of a partnership that was needed to do some partnership tax planning. It might become a kind of blocker vehicle for doing related party sales. So those are some things we'll hit briefly at the end on some of those enabling functions. So in these 3 rubrics, I just want to think about how non-grantor trusts are useful as separate taxpayers. And we'll start with the statutory one. And to hit it immediately, one of the hottest things going right now is the Section 1202 qualified small business stock. And the benefits there in the middle is that up to $10 million per taxpayer of gain on the sale of stock can be excluded from federal income. Okay. Or there's another rule that's 10 times the adjusted basis of any stock that happens to be sold every taxable year. And these rules interplay in interesting ways and require some planning to get the maximum benefit from them, but this isn't going to be a detailed presentation about that. The point is that the $10 million exclusion is on a per taxpayer basis. So if one taxpayer can exclude $10 million, another one can exclude another $10 million. So if a gift is made of this qualifying stock to a non-grantor trust, what are the effects? And it has two major effects. One is that the qualifying stock retains its status as qualified small business stock, even when gifted to a non-grantor trust. And its qualifying status has to do with the fact that it meets all the other requirements of Section 1202. So it was obtained at original issue. The company has certain capitalization requirements it met, and there's a certain holding period, a 5-year holding period for the stock. All of those things are retained when the stock is gifted to a non-grantor trust. Secondly, is that the non-grantor trust does qualify for an additional per issue benefit. Okay, so this is a statutory benefit that, because it's given per taxpayer, allows us to create another taxpayer and be able to make a gift transfer of stock to that other taxpayer and double the benefit. Okay, this concept is sometimes called QSBS stacking. A few things to note about it. One is that the state of California doesn't follow the federal QSBS laws. So you're in an odd situation where you may owe California tax, but no federal tax on a disposition of QSBS stock. Is there an upper limit to this kind of stuff? Yes, of course. Section 643F has a rule stating that multiple trusts can be disregarded for income tax purposes if they have the same trustees and the same grantors and the same beneficiaries. So we can't just duplicate the same trust multiple times to get this benefit. Also, I put an asterisk on the word gift here, and this gets a bit esoteric, but there's an income tax definition of gift, and there's a gift tax definition of gift. And because QSBS is in Section 1202 of the code, it's referring to the income tax definition of gift. And just briefly, a gift tax definition of gift says that when the donor has relinquished sufficient control and dominion over an asset, then a gift has happened. So it's a softer test. The income tax definition of gift is more about as the identity of the taxpayer changed. So as it moved from one taxpayer to another, very clearly under state law as it moved. And was there no consideration given such that carryover basis applies? And so, and the income tax, we don't have to worry about whether it meets a gift tax definition of complete or incomplete gift. Okay, a complete and incomplete gift is a rubric that arose under the gift tax rules and has to do with the degree of dominion and control relinquished. Income tax is just did it change to a different taxpayer and does it have carryover basis? It's a gift. And so we only have to meet that definition to put qualified small business stock into a trust. A similar statutory benefit, which came out a couple of years ago, was 199 Cap A. 199 Cap A provides a limited qualified business deduction for certain business operations of certain qualified trades and businesses. There's an income phase out for the deduction that starts relatively low for other tax credits. It starts around $150,000. It starts to phase out as a benefit. It's further limited by the amount of W-2 wages and basis in the qualified trade or business. However, it's a useful deduction that's granted in the code on a per taxpayer basis. That means a non-grantor trust could qualify for a separate deduction. What that means is it gets the new income limitation amount. So if we run out of 150,000 or however what the top end of that is, on the normal taxpayer 199 Cap A, a trust would get a set of income against which to take the deduction. But it's still limited by this amount of W-2 wages and or basis that's in the qualified trade or business. So it's slightly more marginal or significantly more marginal tax benefits available. And since there are costs to operating non-grantor trusts, and there are the headwinds we mentioned, there's a compressed rate structure for federal taxes, for instance, maybe hasn't taken off quite as much as QSBS has. But that's an example. This is an example of a kind of per taxpayer statutory benefit that a non-grantor trust could benefit from. Let's move on and just briefly touch on some of the jurisdictional benefits of non-grantor trusts. And this is primarily that question of, can a non-grantor trust live in a different tax jurisdiction, have a different tax residency from the settlor of that trust? The answer is yes, but let's first look at the temptation to put assets in a non-grantor trust offshore from the United States. So can we escape United States taxation? And the answer to that is that's a really uphill battle for US persons, US citizens and residents to put property in trusts offshore. There are some significant disincentives to do that built into the code. One example is Section 684. If you have gain property you're going to put outside, there's a provision saying you're going to recognize that gain as it leaves the shores of the US, as the asset leaves. As a kind of exit tax for trust transfers, in addition to individual immigration out of the US, where something similar applies. And it's not unusual. Many countries with sophisticated tax systems have some kind of exit tax to prevent built-in gains from leaving their shores to be realized elsewhere. And we would have that if assets are moved to a trust as well by a US taxpayer. There's also those throwback rules I wanted to mention earlier because I knew they would come up now, which is the concept that for income accumulated offshore from the US, it might accumulate in a jurisdiction that doesn't charge any tax to it. So it might accumulate with zero income tax. But as soon as a US resident beneficiary gets that a distribution from that trust, the past income is tracked and is back taxed essentially to the beneficiary at that time. That's another disincentive to accumulating income in offshore trusts. And it's a sophisticated enough provisions here to have an interest rate as well, to be a disincentive to just a time value or try to accumulate and defer the tax liability. If interest is accumulating, you lose the benefit of deferral. So offshore, and there's a lot, this is a whole presentation in and of itself, but suffice it to say for now that there's a few disincentives to going offshore. How about onshore? Can we switch jurisdictions within the US? And of course we can. And even some select states will either have no income tax at all, as we know, or some have an income tax for their domestic residents, but choose to tax trusts without a state settlors at a 0% tax rate. That's, for instance, Delaware does that. So we can imagine setting up a non-grantor trust in a state that has no state taxes. However, state sourcing of income is an issue, and the many complicated state nexus rules must still be carefully navigated. Let's just quickly step back and combine the jurisdictional question of where can we cite as a trust with a statutory example of a benefit of a non-grantor trust and revisit QSBS for a moment. I may have mentioned that California doesn't follow QSBS, so you're going to pay full California tax when you dispose of qualified small business stock. But what if you put some of that QSBS in a non-grantor trust and it's in a state that charges 0% income taxes to that trust? You have a completely onshore, completely legal 0% tax strategy in the US that may be excluding up to millions of dollars in income. And that's just why this seems to be the best thing going recently in the tax code. Now we're talking about making a completed gift here. So for estate and gift tax purposes, we're transferring assets to a trust. It's going to use up estate and gift tax exemption. That means there's a limit. There's a limit of that exemption amount that's available, which is a record high amount today. And there are the QSBS limits, which are $10 million each per substantially similar trust. And so there's some natural limitations here to how much you can do this, but it's still a lot of savings are possible through a strategy like this. Of course, I mentioned that if you're going to use non-grantor trust jurisdictionally within the US, you need to carefully monitor the income taxation of the trust by all the various states that it might have contacts with. And historically, states in the US use a variety, a grab bag of different factors in order to capture trust income in that state. And some of them are where the resident is, where's the residency of the person who funded or created the trust? How about what's the residency of the fiduciaries of the trust? What's the residency of the beneficiaries of the trust? The books and records or administration of the trust occurring within that state. And there's almost, many states are similar, but there's almost 50 different ways states can choose to try and tax trust income. famously recently, only because I hear anecdotally that we only get a trust income tax case in front of the Supreme Court once a decade or once a generation, or something like that, is that we had the Kastner case recently, which said to North Carolina that a beneficiary residing in your state, but who is not entitled to income distributions or is not receiving income distributions, can't remember which, is not enough of a basis for the state to tax the trust income. That's low-hanging fruit that even California doesn't try to do. So it didn't directly impact us here, for instance. California has, multiple layers of this. One thing to watch is source income. It doesn't matter where in the world you reside. You can have a trust out of state and it doesn't matter. You could live in Mongolia. You're going to pay California tax on source income that you receive from California. Traditionally, that includes categories of things like California real estate income, employment services, income from employment services rendered while employed in California, so W-2 income in California. And business activity income, which has a complicated set of sourcing rules on its own, but doesn't mean ownership, intangible ownership of business entities necessarily. And we won't go into all the sourcing rules for that, but business activity income underneath the entity level can be sourced to California according to a number of factors. In addition to taxing source income and trusts, California will tax trust income if there's a resident fiduciary in California. If there's resident beneficiaries in California who have some kind of vested entitlement to trust income. So we'll call them non-contingent beneficiaries, so there's no condition to them receiving trust income. And California has a version of that federal throwback tax, which we keep coming back to as a concept. California has a version that's much simpler or much less developed, I would say, in fact, than the federal throwback tax. And California will, if a beneficiary was non-contingent and income accumulated outside of California, escape California tax for a year. In a future year, when that California beneficiary receives distributions, so becomes non-contingent, then California will back tax that income. Interestingly, without the punitive interest rate that's a feature of the federal system. So a non-grantor trust with a California settlor is going to want to watch these 4 items for California purposes. That the trust doesn't earn California source income, or if it does, it's going to pay California taxes anyway on that income. But all fiduciaries, and that might be a trustee, that might be all the roles that inhabit directed trust in out-of-state jurisdictions, trust advisors, investment advisors, distribution advisors, trust protectors, likely should all be outside of California. I know there are those who want to parse definitions of those and say they're not really fiduciaries, but for these purposes, we'll just say let's get those people outside of California. Beneficiaries may, of course, reside in California, but they have to have contingent interest, and this usually means trusts are discretionary, so that there are no rights. If there's no ascertainable standard that a beneficiary could enforce, there are no other standards a beneficiary could enforce to get the income. And California resident beneficiaries don't actually receive distributions. If they do, the tax is going to accrue in California for the year of the distribution at least, in addition to possibility of throwback tax in the future. So you have to meet these requirements to use non-grantor trust jurisdictionally from the state of California. Now, we've talked about making a completed gift to an out-of-state trust, and what does that mean? When you do so, the gift tax system applies, and so we're either using exemption or we're paying gift tax. And since paying gift tax is rarely worth it to put assets away in trust, we're using up to the exemption amount for this. And normally, in order to make a completed gift, the settlor retains no dominion or control of those trust assets. Why would we want to then look at doing an incomplete gift? Well, an incomplete gift does not cause any gift taxes to apply or any gift tax exemption to be used. And in that scenario, the settlor retains some control or dominion over the trust to make it an incomplete gift, and as often remains a beneficiary. Since the assets haven't been gifted away, the settlor is going to remain possible for the settlor to get the assets back. Why might we look at an incomplete gift trust given this setup? Well, completed gift non-grantor trust, we could accumulate income in a no tax state if you go through the California gauntlet. And we don't have source income here. However, these are going to be limited to the gift tax exemption available at the time of transfer. So an incomplete gift might be useful when the amount being transferred exceeds the available gift tax exemption amount. So amounts in excess this year of the $11.7 million. Also, a more narrow idea is some assets have special rules about gifting them. And that might include certain kinds of carried interest under Section 2701, where a valuation rule will apply to take away the advantage of making a gift. Well, those code sections in 2701 to 2704 don't apply when you have an incomplete gift to a trust because they operate on a valuation basis. Those might be situations in which you might consider an incomplete gift trust. Now, I tried to not make this presentation a tedious recitation of the grantor trust rules of Section 671 to 679, but consider if I'm making an incomplete gift, consider these rules anew, okay? The trustor, remember, the settlor or trustor is a beneficiary, usually of an incomplete gift trust. So it's possible that the settlor can receive income from the trust. So we've got to go back to these rules that would turn it back into a grantor trust in that case. You have to watch loans to the settlor. And there's a complex series of rules that unfolds in Section 675 about loans and grantor trust that have exceptions and exceptions to the exceptions. You have to go through that and determine under what conditions might loans be possible to a settlor while retaining non-grantor trust status. And the settlor cannot control the beneficial enjoyment of income or principal, but the settlor is sort of interested here and has to have some control to not make it an incomplete gift, has to retain some control. So how do we retain that incomplete gift control, but somehow not have control of beneficial enjoyment for income tax purposes? So we have a non-grantor trust. This very question creates a fundamental tension in incomplete gift non-grantor trust. The transfer has to be complete for income tax purposes. We have a non-grantor trust. It's no longer taxed to the settlor, but somehow it's not a completed gift for gift tax purposes. If you step back and put this in context, just step back for a moment. This is the complete inverse of what we do when we do grantor trust planning, where we have trust, we want to make completed gifts to grantor trust so we get assets out of the estate tax system in the future. But they're incomplete for income tax purposes. The income remains taxable to us. And we got comfortable doing that because the definitions of completeness for income tax and gift tax purposes evolve separately. And there are some themes in between them. And there are some powers you can retain under the grantor trust rules to have something taxed to you that really have nothing to do with whether it's a completed gift for gift tax purposes. So we can retain just those powers. They don't affect it as a completed gift for gift tax purposes. And we can make the inverse of what we're talking about here. We can make a completed gift grantor trust. In the inverse, the themes that are different between income and gift tax purposes line up differently. And it's a much narrower needle that has to be threaded to make an incomplete gift non-grantor trust. And it's resolved through the narrow needle that's left is that when powers over a trust are held jointly by several people, that's where the gift and income tax rules differ on how they view that. And I almost titled this presentation, Two Cases from 1939 that Still Haunt Trust Planning Today. The gift tax regulations come from a case called Sanford v. Commissioner. And the gift tax regulations say that if you have multiple power holders and the others have a substantial interest in the exercise, we're not going to treat them as adverse if they can't take in default, it's called, which means if no one exercises the power, they can just sit back and inherit the asset. And the gift tax regs say that is that's to us an incomplete gift because they're not adverse enough. If they can't take in default, the co-power holders with you are not adverse enough to you. You still retain enough control over this trust, dominion and control. We're going to say it's an incomplete gift. Income tax is the opposite. It says that if you have to exercise powers with the consent of adverse parties, we're going to call that a separate taxpayer from you at this point because adverse parties have to vote with you to exercise powers and abuse it differently. And this is the only needle we can thread to make incomplete gift non-grantor trust work, is this difference in the regulations under the grantor trust rules and the gift tax rules. If you look at incomplete gift non-grantor trust, they tend to have the structure that results, which is there's a committee of permissible beneficiaries who decide on distributions among themselves. And you'll find that the Settlor retains 3 different kinds of powers with respect to that committee. I won't go over them here, but that's the resulting structure. And that sort of structure reflects the difficulty of threading that needle between the income tax regs and the gift tax regs there. As the trust, yeah, okay. What are the internal headwinds to doing this kind of non-grantor trust planning? And these are things, you know, before jumping into it, we got to think about. And some of them are dictated by the post-war responses we discussed earlier. But a newer one is the net investment income tax, or Obamacare surtax. That's an additional federal 3.8% tax when you're passively managing investments. And sometimes when a settlor is managing assets, they're doing so actively, especially if it's their own business. And if we move that into a trust, it's very difficult for a trust to actively manage a business. So we might be inadvertently making the assets that were subject to the settlor's income tax rate subject to an additional federal 3.8% tax, and just to save some state taxes. So that's a headwind against the amount of tax we're saving. It might apply, it might not. 2 is that compressed rate structure itself. We're taking federal income that's earned at the more generous individual income tax rate structure, and we're moving it all into possibly higher federal tax rates. So non-grantor trust planning tends to work for the level of income where the grantor is already paying the highest rates. If you can find that amount of income that's in those highest rates already, there's no difference moving it to a non-grantor trust. Another key point an accountant brought to my attention once that's interesting is that as a brand new taxpayer, a trust, especially if a big gain event's going to happen after assets are moved to a non-grantor trust, trust might have to make estimated tax payments sooner than the individual would have, only because the individual has a track record of the prior year's income as a measurement for their estimated tax liability. But a new trust doesn't and has to start immediately. So we could accelerate some federal tax payments. All of these very important things to consider before jumping headlong into this planning. There are a few external headwinds to incomplete gift non-grantor trusts that I'll end up ending with these items, and we'll have to skip the last few things. But the one is, after a long silence about incomplete gift non-grantor trusts, the FTB late last year issued a statement and proposed legislation to California to curtail and basically end the applicability of incomplete gift non-grantor trusts in California. Something similar happened in New York about 8 years ago, I think. Secondly is maybe some IRS doubts about that very narrow needle we thread. So let's look at these just briefly in turn. In last November, the FTB, I guess, is a regular program for the FTB to propose different legislations it's in favor of. And so it picked up trusts, incomplete gift non-grantor trusts, and in some text with its proposed legislation, the FTB admitted that the strategy seems to work in California, and therefore is asking the legislature to do something about it. And the legislation was to have these kinds of trusts treated as grantor trusts effective after the year after the effective date of the legislation, which would have been January 1st, 2022. I could be wrong. I'd love to hear in the chat or contact me after the meeting. I don't think, it's just hard for me to monitor. I don't think that California has picked up this legislation yet, and we're getting late in the legislative year. It's not impossible, I believe, but I think we're getting late in the year, and maybe the legislature did not pick this up. I have some ideas as to why that I won't share here. IRS has added incomplete gift non-grantor trusts, which have, if you look at that needle we threaded, it's all federal tax issues, even though we're saving state taxes with the strategy. It's federal tax issues that do the heavy lifting here. And the IRS has put these trusts on the no ruling list in 2021. Again, why that is, I'll leave to some speculation, but there might be some doubts within the IRS that the regulations, the difference in regulations in the gift and income and grantor trust rules that we covered a few slides back really means what it seems to. But this is after the IRS has issued many dozens of rulings approving exactly this strategy. So it's an interesting point there. With that, I think we'll just skip through. There's a few other concepts I wanted to cover, which is having a non-grantor trust as a partner in a limited partnership. It's just a separate taxpayer, so it's sometimes a way of creating a separate taxpayer. So you have two different taxpayers in a true partnership. And that enables a whole suite of basis management planning issues that partnerships can take advantage of, including what's colloquially has been called for many decades basis stripping in partnerships and things like that. Sometimes you need a non-grantor trust if you don't have another living family member to add directly into that family limited partnership. A non-grantor trust can serve very well. It's also possible to sell assets to a non-grantor trust. And if you're familiar with international taxation at all, there's this concept of a blocker corporation. A blocker corporation earns all of the income in one jurisdiction where it lives and keeps that income from leaking into another jurisdiction. And you can imagine non-grantor trust could be used in that capacity. The short answer is it's a bit complicated. There is an arbitrage opportunity buried in here when you follow the related party rules for doing installment sales. There's an arbitrage opportunity buried in there that might, in some narrow circumstances, be useful. But complicated rules, you got to check out section 453E, which imposes some requirements if the trust was created by the settlor who's going to sell assets to it. And with that, I'll end just a minute before. Actually, just one more thing is just what's the ongoing prognosis for non-grantor trust planning? Again, the SALT deduction limitations are very harmful to state taxes, possibly being mitigated by a deal that's coming through just right now. Partly mitigated at least. The QSBS stacking opportunity is just too tempting for many people to ignore. As you know, non-grantor trust, it's another side benefit is legal and accounting fees and things like that can be deducted to a greater extent than individuals can deduct those fees if they're not subject to that 2% floor. So there's ongoing reasons why non-grantor trusts are going to stay relevant. With that, I'm really at my limit and we need to close. I'm going to turn the time back over to Dina, but thanks for letting me be here today.
Thank you, Daniel. I've been monitoring the Q&A section. I don't actually see any outstanding questions from the group. So with that said, if there's no more questions, I just wanted to thank you again just for your thoughtful presentation and for being here. I know it's quite a topic to tackle. There's a lot going on, but I do appreciate, and I'm sure everyone does, your time and your expertise in this area. So thank you so much.